Hello everyone. In today's lecture, we're going to discuss the financial statements. The three main financial statements are the profit and loss statement, the cash flow statement, and the balance sheet. First, I want to divide this lecture into three sections. In the first section, I'll give you an overview of the financial statements. In the second section, we'll discuss the financial statements a lender wants to see in your business plan. And then finally, in the third section, we're going to analyze financial transactions and how they impact each of the financial statements. Now, these financial transactions include receiving income from customers, paying business expenses, and purchasing equipment. All right, so let's get started with section 1, an overview of the financial statements. First, let's take a look at the profit and loss statement. Here is an example of the profit and loss statement for the ABC Trucking Company after their first year in business. So, the profit and loss statement shows managers and investors whether a company made money or lost money. It is also referred to as the income statement. And there are three sections to the profit and loss statement: revenue, expenses, and net profit. The revenue represents all the money a company brought in during a specific period of time. The expenses represent the cost of running the business. So the profit is equal to the revenue minus the expenses. So let's take a look at the profit and loss statement for ABC Trucking Company. The income received from all of its customers for the year totaled $147,000. All of the expenses paid throughout the year totaled $127,825. Subtract the expenses from the revenue, and that gives you a net operating income of $19,175. Subtract depreciation of $21,429 from net operating income, and the company has a negative net profit of $2,254. Now, a little bit about depreciation. Depreciation is an accounting method used to allocate the cost of an asset over its useful life. Depreciation represents how much of an asset's value has been used. Let's watch a short video for a little bit more context on depreciation.
Depreciation indicates how much an asset's value has been used up. It also tries to match the expense of an asset to the income that the asset helps the company earn. Used as an income tax deduction, depreciation calculations offer businesses an annual allowance for the use and deterioration of tangible assets. Tangible assets are those that have a physical form, such as machinery, equipment, and buildings. For example, Dave's print shop buys a piece of equipment for $500,000 and expects it to have a useful life of 5 years. It will be depreciated over 5 years. Every accounting year, the company will expense $100,000, which will be matched with the money that the equipment helps to make each year. This is called a straight-line depreciation. The asset stops being depreciable when its cost has been fully recovered, or when it is taken out of service. Whichever happens first depends on the business.
So in our example, the ABC Trucking Company purchased a dump truck for $160,000 with a useful life of 7 years. Although the company purchased the truck in the first year, they have to allocate the cost over 7 years as depreciation. So annual depreciation cost is $160,000 divided by 7, or $21,429. Okay, so let's talk a little bit about this negative net profit. ABC Trucking Company has a negative net profit of $2,254 for the first year in business, meaning they had a loss in the business. Now, this is not necessarily a bad thing because most investors and lenders expect a loss for a startup business in certain industries. It is important to note that the profit and loss statement does not show how much money is in the bank. That is reflected on the cash flow statement. The profit and loss statement shows how much money came in from your customers, which is not the only source of money in your business bank account. Other sources can include loan proceeds, the owner's investment, and investments from others. So I said all that to say this: if you have a negative net profit on your profit and loss statement, that doesn't mean that you're out of cash. It just means that the business had more expenses to pay out than income that came in from its customers during a specific period of time. As long as you have cash in the bank, the business can continue to exist. So keep in mind that a negative net profit on the profit and loss statement is not necessarily a bad thing. As a matter of fact, it is expected for the first couple of years for a startup. Now, before we move on, I want to go back to the expense section and talk a little bit about the loan interest expense. I want to elaborate on this line item because it can be a bit confusing as to why the interest is recorded here, but not the total loan payment, which includes both interest and principal. Okay, so let me start by defining a few terms as it relates to a business loan. The principal is the amount you borrow from the lender. The interest is the extra money the lender charges you for lending you the money. When you make your monthly loan payments, a part of it goes to pay down the principal and a part of it goes to pay the interest. Let's use an example. Let's say you borrow $1,000 from the bank and the interest rate is 8%. Then the bank is going to charge you $80 in interest, which is $1,000 times 8%. This means that when you pay back the bank, you have to pay back $1,080, $1,000 in principal and $80 in interest. The $80 is an expense to the business and is recorded in the expenses section of the profit and loss statement. The $1,000 principal is considered an exchange of funds. The lender gave it to you, you gave it back. So, where do you show the repayment of the principal? It is shown on the cash flow statement, which is a great segue into the discussion of our next financial statement, the cash flow statement. This is a very important statement because it shows if the company needs to shut down due to lack of cash. Unlike the profit and loss statement, the cash flow statement with a negative bottom line balance is never good. This means the company has no more money in the bank. So, what is the cash flow statement? The cash flow statement is a financial statement that summarizes the amount of cash entering and leaving a company. It's basically your checkbook register. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. The cash flow statement allows investors to understand how a company's operations are running, where its money is coming from, and where money is being spent. It is important because it helps investors determine whether a company is on solid financial footing. So let's just watch a real quick video from Oracle to give us more context on the cash flow statement.
A cash flow analysis reveals how much money is going in and out of a business over a given time period. Analyzing cash flow helps organizations draw conclusions about the current state of business, whether there's enough cash on hand to cover expenses, or if additional financing will be necessary. Cash flow analysis begins with creating a cash flow statement, which records the actual cash inflows, like sales and investment income, and outflows, such as vendor payments and taxes. This data is then used to review and analyze a company's cash position, spotting trends and making adjustments. By analyzing cash flow regularly, organizations are better prepared to manage evolving financial situations, helping ensure there's enough money to continue to run and scale the business.
All right, so let's take a look at the cash flow statement for the ABC Trucking Company. Let's start with the cash inflows, which shows all the money coming into the business. The revenue from operating represents all the money received from the customers. The owner's initial investment is what the owner contributed when the business started, and increased borrowings are the proceeds from the business loan. This gives them a total of $307,000 in cash inflow. Now, let's take a look at the cash outflows. The expenses from operating are the expenses they paid to operate the business. And here's where you will record the repayment of the principal on the loan. If you recall, the interest portion of the loan payment was recorded on a profit and loss statement as an expense to the business. So, If the owner withdrew funds from the business throughout the year, it will be recorded in this section as well. And finally, the purchase of the dump truck and other business assets are recorded here. And this gives them a total cash outflow of $302,925. If you subtract the total outflow from the total inflows, it gives you a balance of $4,075. This is the cash balance in the bank at the end of the year. Now let's talk about the last financial statement, the balance sheet. So the balance sheet shows what a company owns, its assets, what it owes, its liabilities, and its investments, the equity. There must be a balance, however, between the assets, liabilities, and equity. In other words, a company's assets must equal the liabilities plus the equity. All right, so let's take a look at the balance sheet for the ABC Trucking Company. First, let's start with assets. This is what a company owns. The company has a cash balance in its bank account of $4,075 at the end of the year. Now, this was taken directly from the cash flow statement. So the company purchased a dump truck for $150,000, and throughout the year it depreciated, leaving a balance of $128,571 for the truck at the end of the year. The liability section shows what a company owes. For the ABC Trucking Company, the liability section reports the loan of $145,000 plus principal payments made throughout the year, leaving a balance of $119,900 at the end of the year. In this section, the company will also report any credit card balances or other liabilities such as payroll taxes incurred but not yet paid. The equity section shows what the owner's investment in the business is. The equity section records the owner's initial investment in the company and any additional investments the owner made throughout the year. It also shows how much money the owner withdrew. The net income is reported here because the owner gets credit for the company's profits. And if it's a negative net income, then the owner takes responsibility for the company's losses. As you can see, the assets equal liabilities plus equity. It is important to note that all three financial statements are connected, which means that a financial transaction recorded on one statement can affect the totals on the other two statements. Here's a visual depiction of three connections between the three financial statements. Let me give you an example of how the connection works. Let's say you landed your first contract and your client pays you $500 for your services. Well, that $500 payment is going to be recorded on your profit and loss statement as revenue. When you deposit the money in the bank, it's going to increase your cash inflow, which increases your bank balance as indicated on the cash flow statement. That increase is recognized on your balance sheet as an increase in assets. So we'll be able to see the connections a whole lot better when we record your financial transaction in the last segment of this lecture. But before we do that, let's move on to section 2 and talk about putting your financial statements into your business plan. Alright, so let's go back to the business plan for Vivian's Hauling Company. And also let's open up the startup spreadsheet. Now, if this is your first time seeing this spreadsheet and you want more information on how we came up with these projections, then go back to Google Classroom and review Lecture 3. And you can also download this spreadsheet from Google Classroom. Now, for those of you who are familiar with this spreadsheet, you'll notice that I added a few tabs at the bottom, one for each of our financial statements. Now, we'll look at those in a minute. But first, let's get this table and chart into our business plan. Okay, so the first thing you want to do is highlight this entire table and then right-click and select Copy. Go back to the business plan and scroll down to the section titled Required Funds. Right-click and under Paste Options, you want to select the Picture option. Click on Picture. Okay, the next thing you want to do is click on the table and then select this layout option and go down to in front of text. Now this will just allow us to be able to freely move the table around. All right, so now we can move the table and adjust it to where we want it on the page. You can also resize this table by simply dragging the corner. Okay, so we have that in place. Go back to the spreadsheet. We're going to do the same thing. Right click, select copy, come back to the business plan. We're going to right click and under paste options, select picture. Now you'll notice that it didn't pop in, so what happened, it actually jumped down to the next page. So now you want to select the picture, select the layout option, and then select in front of text. Okay, so that moved it back up to the top page. And then again, we can move the chart around. You can resize it as well. Okay. All right, so now that we have that done, let's go back to our spreadsheet and talk about the financial statement for the business plan. First, let's take a look at the profit and loss statement. Now, for your business plan, you need to show a 3-year projection for the first 3 years in business. That's why the term pro forma is used. So here we have a projection of the first 3 years in business for Vivian's Hauling Company. All right, so let's start with year 1 and kind of go through each of these line items. All right, let's start with the revenue. So we anticipate that during the first year of business, Vivian's Hauling will generate $129,000. Now, the first thing your lender is going to ask you is, how did you come up with that number? And I want you to be in a position to be able to explain it to them. So here's the way, the method that I used to determine this $129,000. And I want each of you to come up with a method that you can prove your revenue. Okay, so this is the method that I used. So in the dump truck industry, the dump truck will not necessarily work year round. Okay, there are going to be times when the dump truck is not working. For example, if the pit is closed and you're working on a job where you need to haul from out of the pit, right? And there are times the pit may be closed due to weather, holidays. You may have some mechanical issues with your truck, which causes your truck not to run. Or if you have drivers, you know, there are cases when drivers may call in. So you want to allow for those weeks where your truck is not running. So what I decided to do is just kind of break down by month how often I anticipate that the truck will run. So here, for example, the first month, you know, I indicated it'll run 3 weeks. The second month, 4 weeks out of the month. And then all the way through, and we got a total of 43 weeks we're saying the truck will run out of 52 weeks, right? Okay, so how many hours then is that per month? So if the truck ran 3 weeks, and we're saying it's going to run for 40 hours every week, so that's 120 hours that we're saying that the truck will run in the first month. 160 hours the second month. The same method used to calculate 120 hours in the third month. Okay, so what we've determined is that based on the industry average, we should make about $75 an hour. Okay, and now your lender is going to ask you, okay, so how did you come up with that number? One thing you can do, and what I did was I found a prime contractor that was willing to give me a letter to say that, okay, here is what I pay my dump truck drivers. Okay, and so whatever rate that is, you know, you want to put it in the spreadsheet. Now let me just say something about the spreadsheet. It's definitely interactive, so as these numbers change, your bottom numbers will change as well. Okay, so In this instance, we're saying we're going to make $75 an hour. We worked 120 hours. So for the first month, our income will be $9,000. And we'll do that all the way across. The second month, we worked 160 hours. That's based off the fact that we worked the entire month pretty much at 40 hours a week. 160 hours, $75 an hour. We made $12,000 that month, a pretty good month. So we'll do that all the way across and total up all of the amount we made for each month. And this is how we came up with the $129,000. So you want to basically use this same type of calculation method so that you can have a strong footing when you're talking to your lender. This is what we anticipate we will make. Now, the second year, I have an annual growth percentage table. So we're saying that we will grow the second year by 1%. So what this calculation is doing is taking your $129,000 the first year and increasing it by 1%. And the same holds for the third year. It's taking the second year income, increasing it by 2% to come up with this $132,000. So now let's say you feel like, okay, we'll make more money the second year. Let's say perhaps we'll increase it by 3%. So what this spreadsheet will do is whatever number you put in here, it's going to adjust your year 2 revenue. So if we put 3%, we should expect this number to increase. So let's say we put in 3% year 2. Now what we should see when I hit enter is that this number should increase. So let me hit enter, and it did. Now if this number increases, that means third year is going to increase as well. All right, so let's just put this back at 1% for now. All right, so let's go through and talk about the expenses. All right, so payroll. If you hire a driver, you're going to have to pay payroll and payroll taxes to the federal government, state government, and possibly some local governments for hiring your employees. So this number includes payroll for one driver at $19 an hour, including payroll taxes. All right, now as a startup business, you're going to have some advertising and marketing expenses. So we anticipate $8,000 because you're just getting started. So you're probably going to spend a lot of money on getting the word out about your business. And as you go along, you'll see that this number should decrease from one year to the next. Fuel is a huge cost. For those of you that are going to use this spreadsheet for fuel, this is basically saying for every day that you run, you're going to spend somewhere around $100 a day in fuel for your dump truck. Licenses and permits are those things that you need to get started with your business. There are certain licenses that you need, certain permits. Professional fees, if you need to hire an attorney or an accountant, you want to put that here. Insurance costs is another big one in the transportation industry, in the dump truck industry. So you'll have your insurance costs. This also includes your, of course, your down payment and then your payments throughout the year. All right, closing costs and attorney's fees. This is what it costs you to close on your loan. So the first year you have that, and you'll notice that the second and third year you shouldn't have this expense. Maintenance. This is another big one. Miscellaneous costs. The first year we kind of said we have some miscellaneous costs. Internet and subscriptions. This is basically for the use of the internet, whatever it costs you to have internet access. You have different subscriptions that you have. You have your payroll subscription if you decide to do the accounting yourself. And we're going to talk about using QuickBooks as a software that we will use. So there's a subscription, monthly subscription for that. And any other business expense that you have that may have a subscription tied to it. Your office supplies, so your paper, ink, anything that's needed in the office. And then here is that loan interest expense that we talked about. So we anticipate the first year to have $143,111 in expenses. Subtract that from our revenue, we have a net loss. And then we talked about the depreciation. All right, and so that gives us a negative net income for the year of $39,826. And we can see that with each year, although we're still operating at a negative, it's looking better. It's not as big of a deficit. All right. So at this point, let's take a look at how these numbers are going to impact our cash flow. Remember, we said that the cash flow lets us know how much money we have in the bank at the end of the year or during any specific period of time. So let's take a look at the cash flow for year one. All right, so we're going to look at our cash inflows, our cash outflows, and what we have left at the end of the year. So we didn't sell any business assets. The revenue, our inflow, this is what came into the bank, and this is coming directly off of our profit and loss. Remember the $129,000. So we have $129,000 coming in from our customers. This number is our owner's initial investment. Okay, so from our startup, we said, let's go back to the startup tab. We said that we needed $215,000 to start up. The owner is going to bring in 10% of that. So $21,500, and then we're going to borrow the difference of $193,500. So the owner is going to deposit $21,500 into the bank, and then you'll get the loan proceeds of $193,500 deposited into the bank account. This gives us total inflows of $344,000 for the year. All right, let's look at our outflows. So throughout the year, we had business expenses, and we anticipated to be $143,111. So that's coming straight from our profit and loss statement. These are all of our expenses. Now, remember we talked about the principal repayment. Because the principal amount is not included in your expenses, this is where we have to actually show it, because when we pay the loan back, remember we're going to pay the principal and the interest. So let's kind of take a look at this loan tab. Let me show you what I'm talking about. So remember, this loan tab is going to show us how much we have to pay back every month on that $193,500. So $3,064 every month. So we pay that every month. At the end of the year, we would have paid $36,772. $21,136 went to principal. $15,637 was paid towards the interest. So $21,136 principal. $21,136 principal is part of our outflow. We've already included the interest in this figure. So let me just show you. The $15,637 is here. It's already accounted for. And so we're going to account for the principal here as part of our outflow money that we paid out. And we also purchased our assets as well. This is the dump truck and the furniture equipment. So total outflows, what we paid out for the year is $344,247, which means that we have a negative, we are anticipating having a negative balance in our bank account at the end of the year. This is not good. If this number is negative, then your lender is saying, okay, then you're going to be out of cash, which means that you're going to be out of business. So this tells me we need to make an adjustment either in our revenue or in our cash inflows or an adjustment in our cash outflows. Since we've already determined pretty much how we're going to get our money, let's not touch the revenue side, but let's take a look at our expenses. If we can somehow reduce some of our expenses, this is going to make this number look better. Okay, we want to put this number in a positive light, and one way to do that is to reduce our expenses. So let's go back to our profit and loss statement and see where can we reduce some of our expenses. So let's take a look at our expenses. All right, the first place a lot of people will look is in this payroll line. So Vivian decided to hire a driver the first year. So perhaps, and let's see how we came up with this $36,000. Let's take a closer look at it. Now, what I have available is a few hidden rows that I want to open up to show you how we came up with this $36,275. So let me just unhide those for you. All right, so this is how our payroll looks. The first year we've decided to hire a driver and pay that driver $19 an hour. So the truck ran, as we indicated here, 120 hours for the month, the first month, and this is how we got the 120. So the driver drove 120 hours at $19 an hour. The first month it cost us $25.31 to hire that driver. Now that includes payroll taxes as well. All right, so let's say Vivian decides that she's going to drive the truck herself the first year. So let's just take this out just to get rid of our payroll for the first year. So before I delete that, we do expect that once we delete the driver, then this number should go to 0, which means our expenses are going to be reduced. Let me delete out the rate, and that's exactly what happened. Our payroll went to 0. All right, so we were looking to reduce the expenses, and we did. All right, so let's take a look at the impact that this has on your cash flow. So it reduced our expenses to $106,837, which means that it reduced our total cash outflow, and it increased. So we no longer have a negative cash balance. By Vivian driving the truck herself for the full year, she now has $36,028 in the bank. Okay, now one question that the lender is going to ask, well, if you're driving the truck, then how are you going to take care of your personal expenses? You can give the lender is that, well, I'm going to withdraw some money out of the business. And this is where you can withdraw money out of the business. So they're going to want to see how much you're going to withdraw out of the business to be able to maintain your personal expenses. So let's say you feel like, okay, you need, $1,000 a month. So we can put here $12,000 that you're going to withdraw from the business. Because you're driving the truck yourself, you need money to take care of your personal expenses. And so it still keeps you at a positive cash flow. Okay? And so this looks good the first year. Now what I want to do is expand this out a little bit to show the years 2 and 3. All right, we had was the revenue coming from the business. That gave us $130,000 total in cash inflows. The outflows are operating costs from the business, as well as the repayment of the principal, which gave us $146,000 in outflows. At the beginning of the year, we have $7,571 at the end of year 2. Okay, let me say that again. We started year 2 with $24,028, which came from last year. We had $130,000 to come in. We had $146,000 to go out. It left us with $7,000 in the bank at the end of year 2. Now, if we continue this process though, look at what happens year 3. So we start out with $7,571 in year 3. But we have a problem because at the end of year 3, we're at a loss. We're at a loss at the end of year 3. We have no more money in the bank. This is a problem. At the end of the year 3, we have a negative balance in our bank account. So what we need to do is make the necessary adjustments again. So let's say, okay, let's see what happens if maybe we hire the driver instead of the full year. Maybe we just hire the driver for 6 months. Okay, and what I'm showing you this, I just want to show you how interactive this spreadsheet is and some of the things you can do to try to, make certain decisions, how you can analyze what happens when you make certain business decisions. Okay, so 6 months, we need to make some adjustments. All right, so that cut our payroll in half. So let's see what happens to our cash flow statement. All right, so now we're at a positive cash flow at the end of year 1, positive cash balance at the end of year 2 and a positive cash balance at the end of year 3. So what I want you to do is just kind of take this spreadsheet and use it. You can change the numbers. Let's say you hire a driver the first year and you wanted to pay them $15 an hour. This spreadsheet is interactive. You can copy that all the way across. And now your payroll is only $28,000 instead of the $36,000. The rate here is $15 an hour. Okay, and then you can see the impact that has on your cash flow statement. Now, at any point that you have a negative cash balance, you know that you need to make the necessary adjustments. So what I want to do next is show you a bar graph that I have associated with this, so we can bring this in to our business plan. All right, so here's our bar graph that's associated with our profit and loss statement summary. Now, if you scroll down a little bit, here's the summary of our revenue and expenses, our net operating income, and our net profit for years 1, 2, and 3. And so this bar graph is pulling from this table. So for example, for year 1, we have $129,000 in revenue. And so that's what this green bar represents. Year 2, we have expenses of $106,837. So that's what this bar represents. And then year 1, we have our net operating income of $22,163. So this is what we're going to actually pull in to our business plan. Let me go back to the cash flow for a minute, because some lenders will ask you to break this out on a monthly basis. Now, if you have a lender who wants to see this monthly, I do have some hidden columns here. Let me just unhide them for you. So this shows your cash flow statement for the first year on a monthly basis. So you have some lenders who actually want to see this. So it's basically just taking the numbers and breaking it down on a monthly basis. So that's available to you as well. So finally, let's go back to our business plan and pull in our financial statements. So in your business plan, you want to scroll down to the financial statements page. Let's go back to our profit and loss statement. Highlight the table, right click, select copy. Let's go back to the business plan, right click, under paste options, select picture. Click on the picture, select the layout options, and select in front of text. Now, this will allow us to move the picture and also resize it. Let's kind of make it a little bit smaller so that we can bring in our graph. Go back to the spreadsheet, right click on the graph, click copy, come back to our business plan, right click, click on picture, layout options, in front of text, and then just line it up and resize it as necessary. Okay. Then you'll basically do the same thing for your cash flow statement. You bring that in. There's also a graph associated with that, as well as your balance sheet. Follow the same procedure and bring those in. All right, so once you've done that, you basically have your business plan complete. The only thing that's left to do is to put in a table of content if you prefer. But other than that, your business plan is ready to go and ready to be submitted to your lender. Completing your business plan doesn't mean that you're finished with financial statements. Every business owner should review their financial statements on a regular basis. It is very important that you build your financial statements from day one of your business and continue for the duration of the business. This is important for several reasons. First, most lenders are going to require that you submit your financial statements on an annual basis. Some may even require quarterly financial statements. Secondly, if in the future you decide that you need additional funding to grow your business, then you will most likely need to produce financial statements for the lender or investors. During the pandemic, a lot of small businesses missed out on federal funding because they didn't keep financial statements for their businesses. And finally, financial statements are important because it gives business owners and managers an overall picture of the financial health of the business. Many businesses fail because the owner was not aware of the profitability of the company and its cash flow. Now I'm going to show you how to build and maintain your financial statements. We'll start with the manual process of using a spreadsheet to build your financial statements. Then we'll look at QuickBooks, which is an accounting software used for business financial management. So let's go to the transactions spreadsheet and start building the financial statements for Vivian's Hauling Company. Now this spreadsheet is available for you to download in Google Classroom. Alright, so here we are on the transaction spreadsheet. You'll notice that I have several tabs at the bottom. Each tab represents a business transaction for Vivian's Hauling Company. So what we're going to do is analyze each transaction and build our financial statements. So let's start with transaction 1. So as you can see, we have each of our financial statements here, the profit and loss statement, our cash flow statement, and our balance sheet. All right, so we're starting at the very beginning of the company, so everything has a zero balance. And after each transaction, we're going to basically just build our financial statements. All right, so transaction 1. Vivian applied for a $193,500 business loan for Vivian's Hauling Company, and the loan was approved. In order to receive the loan, Vivian must contribute $21,500 of her personal funds as an initial investment into the business. Vivian deposits $21,500 into her business bank account. All right, so let's record this transaction. Okay, so the $21,500 will not have an impact on our profit and loss statement, because this is where we record our revenue from our customers and our business expenses. But that deposit will have an impact on our cash flow statement and our balance sheet. So on the cash flow statement, it is a cash inflow in our owner's initial investment line item. So what we're going to do is just enter the $21,500 here. So that gives us our bank balance. Remember, the cash flow statement shows our bank balance of $21,500. Now let's take a look at our balance sheet. It's going to increase our cash bank balance, $21,500. And we also have to record it in our equity section as an investment by the owner. This was her initial investment into the business, so we will record it here. Now keep in mind, for the balance sheet, our assets must equal our liabilities plus our equity. And so we're going to keep an eye on these two figures to make sure that they are the same. Okay, so just to recap, after transaction 1, as we begin to build our financial statements, the $21,500 will impact our cash flow statement. It will increase it, as well as our balance sheet in the assets section, and also in the equity section. So let's take a look at transaction 2. So just as a note, the balances from transaction 1 is going to automatically come over as our beginning balance on transaction 2. Okay? So as we go along, whatever our ending balance is on the previous transaction will automatically come over as the beginning balance on our next transaction. All right, so let's take a look at transaction number 2. Vivian deposits the $193,500 loan proceeds into her business bank account. So let's go ahead and record this transaction. So that will definitely impact our cash flow statement. as an increase in the loan proceeds. So let's enter the $193,500 here. That will also have an impact on our balance sheet. Okay, so it increased our cash balance. So we have to increase our cash balance on our balance sheet. All right, so this is also a liability. So it is a business loan, so we have to record it here under the liability section as well. All right, and we are still in balance with our assets and our liabilities and equity. So just to recap, after Vivian deposits the loan proceeds, it will increase our bank balance. So it increases our cash inflows, and it also increases our assets and our business loan liability. All right, so let's continue to build our financial statements with transaction 3. All right, so Vivian purchased the dump truck for $175,000. So let's record this transaction. So it does impact our cash flow statement because she wrote a check to purchase the dump truck, and it goes under our cash outflow by purchasing a business asset, $175,000. All right, so what that did is it reduced our net cash flow down to $40,000. It's also going to affect our balance sheet because we're going to reduce the cash that's in the bank. Okay, and it is an asset that we purchased, so we're going to increase our asset. All right, so now we are also still in balance. All right, just as a recap for transaction 3, as we continue to build our financial statements, the purchase of the dump truck will definitely decrease the balance in our bank account down to $40,000, which is reflected on the cash flow statement. It'll also, so it's going to decrease our cash balance that's indicated also on the balance sheet, and it's going to increase the dump truck value. All right, so let's take a look at transaction 4. Vivian needs insurance for the truck. The insurance company requires a $3,500 down payment. Vivian pays the down payment for the insurance. So let's record this transaction. All right, first of all, the insurance is an expense to the business, so that's going to impact our profit and loss statement. So our first transaction on the profit and loss statement is a $3,500 insurance expense. So because we have no revenue, we now add a net operating loss after this first transaction. Now, this will also impact our cash flow statement because it is an expense that she paid out of the bank account. We also have to record it here on our cash flow statement. All right, so what that did is it reduced our net cash flow to $36,500, so that is what we have in the bank. Now, this will also impact our net profit as well. It decreased on our profit and loss statement, so we're going to have a decrease in our equity in our profit and loss for the current year. This also decreased our cash as well, as we've already stated. Okay, so we still have our assets equal to our liabilities and our equity. So to recap, when you have an expense in the business, it's going to impact your profit and loss statement by decreasing the net profit. It's also going to impact your cash flow statement because you're writing a check for the expenses, so the money's coming out of the bank. It's going to impact our balance sheet in the assets section as well as in our equity section as a reduction in our profit and a reduction in our cash. All right, so let's take a look at transaction 5. Vivian lands her first contract. The client wants her to haul dirt to a construction site for $10,000. Vivian completes the job and the client gives her a $10,000 check that she deposits into her bank account. So how does this impact our financial statements? So let's record this transaction. First of all, it will impact our profit and loss statement because we received revenue from our customers. So we're going to put $10,000 here in our revenue section. And so as we build our profit and loss statement, we see that our revenue minus our expenses will give us a net operating income now of $6,500. All right, so where else will this $10,000 apply? It will apply on our cash flow statement as revenue. Okay, so that increases our net cash flow. Now we have $46,500 in the bank. Now this also impacts our balance sheet. We're going to increase our bank balance again at $10,000, and also we increase the net profit in the business. All right, just to recap. Whenever we have a payment that comes in from our customer, that's going to impact our profit and loss statement as we continue to build our statements. It's going to impact our cash flow statement as well as our balance sheet. All right, so let's take a look at transaction 6. Vivian purchased fuel for the truck as she was completing the job. She has $1,500 in fuel receipts. Let's record this transaction. All right, so how does that impact our profit and loss statement? There's an increase in fuel expense of $1,500. All right, so we had an increase in expenses, which decreased our net profit from $6,500 down to $5,000. We also have an impact on the cash flow statement in the expense section as a cash outflow of $1,500. So that reduced our net cash flow from $46,500 down to $4,500. Now let's see the impact that it has on our balance sheet. It decreases our cash, and it also decreases our net profit. Okay. So as we continue to build our financial statements, we can see the impact of every transaction. All right, finally, let's look at transaction number 7. Vivian makes her first loan payment, and the bank sends her a statement showing how the payment was split between principal and interest. So here we see the bank statement from the bank. She made a $3,000 monthly payment. $2,000 of that went to principal, $1,000 went to interest, leaving her an outstanding loan balance of $191,500. All right, so how do we record this transaction? Now this one will have a lot of moving parts. So let's start with the profit and loss statement. All right, so we've already said that our interest is an expense to the business. So we're going to record the interest on our profit and loss statement. So that increases the total expenses that we have in the business, which will decrease our net profit down to $4,000. All right, let's see what type of impact that this is going to have on our cash flow statement. So we know that the $1,000 is an expense to the business. And this is where we record the repayment of the principal. So the repayment of the principal was $2,000. So now we've captured the entire $3,000 that we paid out of the checking account. So our net cash flow went from $45,000 to $42,000 after the loan payment. All right, now let's see the impact that this has on our balance sheet. Okay, it's going to reduce our cash balance by the $3,000 that we paid out. Now, we've paid down the principal on the loan. So the amount that we paid down was $2,000. So that leaves us a total business loan balance of $191,500, and that's equal to what the bank has on our statement as well, as an outstanding loan balance of $191,500. Now, it also impacts our net profit because the $1,000 in expenses reduces our net profit. And as we can see, our total assets still equal the total liabilities and total equity. So at the end of transaction 7, what we've done is we've built our financial statements. At the end of transaction 7, we have a profit and loss statement balance of $4,000. We have a cash flow statement balance of $42,000. And our balance sheet statement in assets and liabilities and equity of $217,000. So this last tab we have here just kind of sums things up and puts our headings in place. Okay, so this was just our manual process of building our financial statements. After each next lecture, we're going to use QuickBooks that will actually automate this process. We went through each transaction manually to generate our financial statements. But you'll see with QuickBooks, it will automatically generate these statements based on the information that we put in QuickBooks. So until then, I would like for each of you to download this spreadsheet and go through each of these transactions again. What I'll do is add some more transactions that you can complete and enter in on your own. All right, thank you so much, and I'll see you next Saturday.